Hey, it's Brian Strain here, and I get to do our webinar tonight. And I just want, before we get too deep into this, if you could just in the chat let me know that you can hear me okay. Perfect. Good. Thank you, Nathan. Thank you, Lee. Thank you, Abraham. All right. So I have we received this question from Abraham actually a little while ago, and it's a great question. He was asking about predicting 5% drops in the S&P 500. He was asking, a lot about put call volume and put call ratio and stuff like that. And so I wanted to give you some up-to-date information on. So there's an issue, right? There's a problem with a lot of option data lately because of the growth in 0 days to expiration options, which we're not really day traders, right? We like to take positions and go from there. We tend to take a little bit more time with things, hopefully a year with stock, over a year, so we can save money on taxes, and we use our options to hedge the bet. And but when you're looking, so I've used put call ratios in the past as a sentiment indicator, and specifically I use it as a contrarian sentiment indicator. So it used to be when I was looking at put call ratios, it was to try and find when there was a bottom in the market, when was I willing to step in front of a runaway freight train onto the track to grab a pile of cash, predicting that the train's going to stop, that they'll see me and that they'll stop. And that's a big bet to make. That's something you gotta be pretty sure about. But so I just wanted to pull up this chart to just show you how the growth of 0 day to expiration options has really grown. And this chart from SIBO goes to 2023, partway through the year, and it's even bigger now. I've seen days where the 0 day to expiration options were making up over 50%, some as high as 80% of the volume that day. So it's just there's a skew, and you just have to be aware of it and what to do with it. So while the put call ratio as a sentiment indicator is still got some good information, but it's probably going to be a little bit late to the party in trying to predict when the market is going down or likely to go down in the near future. And I'm going to show you a couple of different things here, but I like to use implied volatility as an alternative. And if you think of it now, the thing you have to understand about implied volatility is it's not a directional indicator. A lot of people think that rising rising implied volatility is bearish, but it's just not the case. A lot of times, yes, it is bearish, but a lot of times it can be bullish. So we don't want to make bets specifically to the downside when implied volatility gets high, when the VIX gets high. But I want to show you a couple things here. So let's go look at this. So I'm just looking at this last year. I just want to pull in some data, and I marked some spots on here where, so this is the total put call ratio on this lower indicator right here. And when it theoretically in the past, when it gets above 1, it does mean that there are more puts trading than there are calls when it gets above 1. And that used to be the indicator. I'm seeing a lot of my old students from my education stuff in here, and you guys may remember the home run trade where we were using put call ratios to define when we were going to step in front of the train and make a bullish bet, right? But put call ratio by itself is probably a little late to the party. So you can see in this last instance, this going back into April, it wasn't until this day on April 3rd that we got the put call ratio above 1 right there. Now it did drop. It did drop a few days later. It did drop about 7%. Let me pull up the spreadsheet here. Oop, there we are. Yeah, so it dropped 7.5% roughly to get to the end of that there. Oop. I'm going all over the place. So it dropped roughly 7% down here on the 8th. So that was a short downturn, and then it peaked and bottomed out. And what I want you to notice is that when the put call ratio actually, it was still hovering right around 1 here for a little bit, but when VIX spiked and turned over, that was the bottom. That day was the bottom. So is the put call ratio still a good indicator? I think it's a little late to the party when trying to predict when a 5% drawdown in the S&P 500 is going to happen. It did in this case. It did predict something more than a 5% drop. Using VIX to spike when it turned over helped to realize this is the bottom. But you wouldn't know that till the next day when you saw that VIX was climbing back down, right? But what I want to show you here is when VIX crossed above, and it's way back here. It crossed above on February, what was that, 21st? Yeah, February 21st is where it crossed above. And so that's right back here on this day. And so if you got into a bearish trade, if your other technical indicators were indicating bearish at this point in time, and then this gave you a much bigger, if you still use the put call ratio on the peak of the VIX spike here to bottom out, your returns were a lot better. So if you look at this, so you would go from, if you got into a bearish position, the index was at 6,013.13, and on the 8th it dropped down that much. So that was a 17% decline from the point where VIX crossed above the 1-year average, and that's a big move looking forward. Now put call ratios, just some of the things I want to point out with technical indicators. Put call ratio is looking back in the past, right? And it's just telling us there are more puts traded in a day. We don't know anything about whether who is more motivated, because that's the trick question when you come up with options trades. When we look at stock trade, we can say if someone buys the stock, they're bullish. If they sell the stock, they're at least not bullish. They're no longer bullish. And that's the information contained in the stock price. Well, a put call ratio is just saying there's more puts trading than there are calls, but it doesn't tell us who's more motivated. Are the puts being sold at cheaper prices, or are they being sold at higher prices? Higher prices would suggest that the people buying the options are more motivated than the people selling the options. The same thing with calls. If calls are going, up in price, then we could say the people who are more motivated are those that are buying calls rather than selling calls. And so in this case, as a technical indicator, put call ratio can be used to say the demand for puts is higher than the demand for calls. And it gives us that. With the VIX, because VIX isn't directional, it's just telling us, it's giving us an idea of the increase in demand. If implied volatility is rising, that means option prices are going up, and that means the people who are buying them are more motivated than the people selling them. And so when the VIX gets above gets above the 1 year average, then it's saying options are increasing in value. And in this case, that gave us a lead here to the big thing here. So that's just something to look at. I can go back and show other examples where the demand, where we got an increase right here. VIX is above average right there. Demand for options increase, and then the stock went up, the index went up, and volatility started to fall. And typically that does happen, right? When you can get demand for options, and it might have been demand for options because people were getting bearish during this drawdown right here, and you have a put call ratio that's showing you, yeah, there are more puts trading than there are calls, until you get right here, and then it reverses, and we get this little spike, and put call ratio goes down. It pops back up here, but the stock goes off to the races. So VIX isn't really great at telling you. You can have other instances where it's just, this might have been it might have been increasing demand. People were dying for insurance, and put call ratio is above 1, and the market turns and goes back up. So again, I use this primarily as a contrarian indicator. And option data is sentiment data. It's not just directional data, it's sentiment that's telling us what people are expecting in the future when we're looking at implied volatility. Volume doesn't necessarily, it just tells us what people were thinking in the past. More puts were trading than calls. And that happens quite a bit. It's not always a bearish indicator. Like right here, you can see we've got a big old put call ratio spike, and the stock is flat. People were worried, and then market shot up. Volatility was high, put call ratio was high, and then the market turned around and headed back up. So as far as predicting when the market's going to go down in the future, I think put call ratio is a little bit late to the party. Here you get right there. That's when VIX goes above the 1 year average, and put call ratio is high, but it's not quite above 1. And then put call ratio gets above 1, volatility stays high, the market keeps going down until we get a spike here that turns over. You could make a bet, maybe make a short-term bet there, but then it turns around, spikes again, and that spike is the one that's after a double bottom, right? A W bottom, and then it's off to the races again. So my use of put call ratios has been as a contrarian indicator. When we get those, it's usually a good telling of when everybody who was buying puts, when everybody wants to do it and they're paying ridiculous prices, you can tell that they're paying ridiculous prices because of VIX, and you can tell that they're buying puts are being transacted more because of put call ratio. And so it's a good way to help you identify where the bottom's at. And then this one might be a little bit of a W, but you can make a case for a V there too. But that's primarily how I use put call ratio is to identify sentiment when it peaks above 1, more puts are trading than calls. And then if I look at VIX at the same time, when VIX spikes and turns over, put call ratio is above 1, that helps me pick bottoms. It just doesn't happen fast enough because the market's reacting, right? We want, and that's why I use VIX, because VIX is looking forward about 30 days in time, and they only use options that expire on Friday. So they're not using 0 days to expiration options to calculate VIX, unless it's those options that are expiring on that Friday. But they're doing it 23 to 37 days out. So we're not going to see a whole lot of 0-day transactions going on in VIX. And so you get better information for what's going to happen. And it's just going to tell you that there's a big move likely to happen in the near future. The market's starting to expect a big move when VIX gets above average, the 1-year average. Then it helps you to identify that there is a big move. The market's expecting a big move. Things look like they're starting to move. And if it is going to the downside, then you could take a downside position. I tend to try to be non-directional in my trades. So I would, and I don't do straddles on indexes, but I would be looking for cheap options to buy in a straddle situation, so that if the stock moves big in either direction, I'm going to be okay. But that's kind of how I do that. Any questions? I'll pull up this stock while you guys are thinking. All right, no questions coming in. So if you have any questions, just go ahead and type them and I'll get back to it. Anyway, so earnings this week, Baidu, Disney, Micron, still a little further out. NVIDIA, Palantir, Target, Under Armour, Walmart. We've got a lot of earnings coming up, so we are mostly protected, I think, on these. We've been doing a few. You probably noticed some transaction in your accounts. The ones that I need to mention are. So if you were in some of these debit spreads on Meta, we are in the process of rolling a bunch of these out. We've got some December. We've got a couple of Decembers. We have the 610 700 that we are rolling out further. The 610 to 700 is profitable, about $1,100. We've got another December Meta that was the 620 to the 700 that we'll be rolling out, and that one is about break even. I think it's a loss of about $35. And then we had another one that was January Meta that is the 670 to 750, and we're going to be rolling that one out, but that one's a loss of about $1,100. So and overall, it makes sense to go ahead and take what we can out of these and roll it into a new trade that's going to be a little bit further out. We're waiting to find the bottom on those, so we're closing these, and we'll probably get a bottom around 600. Not 100% sure yet, but we're waiting for a bottom. And when we get the bottom, we'll roll out we'll roll out to a different trade. It'll be wherever the bottom is, up to about 700 on that debit spread. Some of you also saw that we've been rolling out some of these micron trades. So we had some January micron trades that were really profitable. These were worth about 1,800 bucks a piece in profit, the 220 to the 300, and we've been rolling stuff out there as well. So that we got going on. The big picture, this is really interesting. If you guys listen to the Fed chair talk, this big picture, the subtitle here, another rate cut in December would be absurd. That's kind of the message that we got from the Fed chair. He pretty much said it's not etched in stone. Don't count on it. It's not a foregone conclusion. Probably far from it. And then he said, he gave an analogy that, you know, when you're driving in the fog, you slow down. And so it sounds pretty solid that the Fed's not going to do anything, especially if they don't have clear data because of the government shutdown. They talked about that. They do have other sources of data where they can get data on the markets, but he gave that analogy about being in the fog when you don't have great data. It might be the time to slow down. So it sounds like that's a situation that we're in. Is it's not likely to be a big another rate cut in December. It could still be. We just don't know. CME went down from, it was about a 90% guess by the market that the Fed funds rate would be down due to another rate cut, and now it's closer to 50-50. So we'll see how that goes. Where will our market end this week? We're still bullish. We're still bullish on everything. We still think things are going to go up. Here's some other earnings announcements this week, quite a bit. Hims, Palantir, that's all there. Yum. There's quite a few out there. Robinhood. We'll keep watching these reports, and these reports, if their earnings are good, they're tending to get good movement in the stock. If their earnings are bad, they're tending to get punished. So we'll see how those things go this week. The news upcoming this week, we've got construction spending today, and we had ISM, PMI manufacturing. The market was positive a little bit today. Tomorrow we got trade balance, factory orders, job openings, and Wednesday we've got mortgage applications, ADP employment, which ADP employment might be what we have to make some decisions on, right? If they don't open up the government to give us the unemployment rate here on Friday. So we'll see what that comes up, how that comes out. Yeah, we'll see how payrolls and unemployment and everything like that. We'll see what numbers come out. I'm not sure what's going to be available or how good the data is. So some of the articles, before I start talking about articles, does anyone have any questions yet? Oh, you're welcome. You're welcome, Abraham. So if you owned Meta, Mod, if you owned Meta, you may have had protection on. I'm not sure because I didn't trade that in my accounts that I manage. But if you were in these debit spreads, you were protected in the fact that you only had so much money at risk. And so rather than continuing to lose money as it continues to move down, because it dropped about $10 today, rather than continue to hold that position, we're pulling those trades off. And I think, and I'm not 100% sure on people that actually own Meta stock where things are going, but if you were protected, I would assume that you still have some protection on there. If you don't, or if you don't own the shares, or if they were called away, I think we may have gotten called away at some point. So I just don't know on everybody's accounts there. So good question, but that might be one that we need to ask Kevin. But I think for the most part, yep, good, yeah, yep. So I think that's where we're at. Some other things. So some interesting news in the market. So just considering, like, we're expecting a Christmas rally. We think that the earnings are going to continue to be good, especially in the stocks that we're investing in. And this article I saw today, option market signals optimism peaks for Magnificent Seven stocks. You can go to that link. It's in your handouts, and we'll put it on the website later. But you can go to that link to read the article if you want to. But it's talking about volatility skew, and if you're looking for things for sentiment, right? And option data is sentiment. People are telling you, I think stock's going to go up. It's going to go up by this much. It's going to do it in this amount of time. And so you can get a lot of information from that about what people's sentiment is and what you're looking at in volatility skew. So a normal skew, it doesn't look quite like this. This green line right here is what I would call a volatility skew smile. It looks like a smile. Typically that's not what these look like. But when you look at this, the options that are out of the money on the call side here are more expensive than the at the monies. The implied volatility is higher. The demand for these options out here at the out of money strikes are higher. And so that's giving you sentiment. People think the market is going to go up here pretty soon. And this is what this article is saying on, what this article is saying is that the Magnificent Seven stocks are kind of smiley. And that's telling us that people are expecting the Magnificent Seven stocks to be bullish. Right here, you can read a sign of extreme bullish sentiment. So we're seeing some bullish sentiment there using the option data, which is good. Good for our positions. We'll continue to expect a rally, a Christmas rally, and we're positioned for that stuff. And we're going to keep holding these stocks as they go forward. We still believe in Meta. It's just we needed to hit a bottom so we can roll into stuff. Nathan's asking, do you have any other indicators you find particularly useful for making your forecast and completing your analysis? Reaching the bottom, what tools do you find particularly helpful for calling that bottom? And really, that put call ratio and implied volatility, that's what I would be looking at. I would look for volatility to spike while the put call ratio is above 1 or really close to the same time. That's what I would use to try and call a bottom. It's not. There was a time when we thought it was 100. We went years with Fishback and never lost on a trade. It was 100%. But with the inclusion of the 0-day to expiration data in there, it's not as accurate as it once was. So I would use every bit of information that I have access to. I don't have a specific indicator that's telling me, but I do use that put call ratio, and I use the VIX to do that. But I also include all the other data that I've got. What's going on in the market? What's Trump saying? What's the Fed chair saying? I'm going to use all that data in my decision making when I'm trying to call a bottom. So some of the news that happened this last week, Trump on Friday cut the fentanyl tariffs on China in exchange for China releasing their precious metals and magnets. And so that was good news for the market, good news to potentially help the market go up. Another reason for us to be a little bullish. The Fed chair again, he was talking about, are we going to have a rate cut? We don't know. They don't know. That's what he was adamant about, is that it's not a foregone conclusion like everybody was expecting, that they would have another rate cut by the end of the year. In fact, he made the case to say that what we talked about is it's not certain that we're going to do that. We don't know. And we haven't made up our minds yet. They're going to keep looking at data and go from there. And then Apple, when they announced their earnings, they said that they see December quarter being driven by strong iPhone 17 demand. So some of you have Apple positions, and I know I put on a couple straddles on Apple for my folks, and we'll keep holding on that. I know Kevin is expecting it not to go above 300, so if we do get something up to 300, we'll probably start moving to take profits on that, and on a move to get out. If you're not out already, then that's probably what we'll be doing. All right, I've covered everything that I had. Anybody else have any questions? Does the shutdown look to have any relevance anytime soon? It does, in the fact that we don't get, now the Fed may have alternate methods to get data, but we don't get unemployment reports. We don't get BLS data during the shutdown. And so yeah, it has some relevance in giving us data to make our decisions on what we're going to do. Because of the Fed's comments, I think it has an impact on what they do as well, on their ability to do stuff, because he gave the analogy that it's kind of like going into a fog while you're driving. And so yeah, it may have some relevance to those things. And so we'll see how it goes. I hate getting political on things, but I think both of the parties involved are so extremely set on a certain agenda that they're going to have a real hard time agreeing. So I have no idea when they're going to. In fact, somebody asked me how long is the government shutdown going to last, and I said I think it'll probably set a record. So we'll see how long that goes on. But yeah, does it impact us too much on our trades? Not so much. Not so much. The only thing that's really difficult for our trading style is the market being absolutely flat. If the market's just not moving, it's just moving sideways and absolutely flat, it's hard for us to beat the market. But any other situation, if it's going up or if it's going down, we tend to do pretty good. And if it's going down, we're not necessarily beating the market, but we're buying more shares of stock. Hopefully, when it's going down, we're buying shares of stock at the bottom, and then we make more money on the way back up. So it's just the way we do things. And so it's not really affecting us that much, other than the fact that we just don't have access to some of the data for our projections, which the Fed might be in the same situation. Maybe not as bad as us, but all right, anything else? Okay, so for you that are looking more for meta, when we hit a bottom, we'll probably get into some more positions there. From the bottom strike up to 700 is what we'll be looking to get into a debit spread. So keep watching for that. Dave is asking, what are the best ways to get a chart volatility skew? I saw you use optionistics. Do you prefer that? No, it's not my preference. It's just a place where I could get them for free today. When my preference, and you probably have already visited this site, Dave, my preference is right here at odds analytics. I like the volatility skew here, but it's not updating, or I would have used this instead. But it's in beta right now, and so you can use this site for free, but it's got a problem right there right now. So, and I haven't had a chance to report it yet. So, and you're welcome, JP, and I hope everyone has a wonderful weekend. A wonderful week. I shouldn't say weekend. I should just say a wonderful week, because we're just getting started. I'm still stuck on the holiday weekend, but that's it. All right. If you have any other questions, please send me email and let me know, and or let Kevin know, and we'll get you taken care of as quick as we can. All right. I hope you have a wonderful week, and we'll see you next week. Thank you. Bye-bye.